The wolf is coming. The wolf is coming. But is it really? Right now, China's stimulus-related announcement feels like a page being ripped straight from The Boy Who Cried Wolf. So the Hang Seng Index gave us an extremely clear response. It shot up past 21,000 points on Tuesday after the big headline on Monday market close, only to fizzle right back under 20,000 points by Friday. So we've heard this same flavor of news so many freaking times. Stimulus this and policy that. And honestly, at this point, are we just suckers? So is this a turning point for China's market or just another round of empty promises? So for a start, what should we take away from this recent Politburo meeting on Monday? So Qing Xiao, founder of RateGate Asset Management, raises 4 points. First, stabilizing the real estate and stock markets. Second, moderately loose monetary policy. Third, strengthening unconventional counter-cyclical adjustments. And fourth, expanding domestic demand in all directions. This definitely sounds like a whole lot of mumbo jumbo to me. So, what does this mean for investors? So let's try to break it down. So to the first point, when we are talking about stabilizing the real estate and stock market, for that matter, for those of you following the Chinese market closely, I actually don't think that this is the first time you're hearing this. So in fact, the same terms were being echoed during an earlier meeting in September where Governor Pan from the PBOC, People's Bank of China, disclosed several market initiatives. With one, a market stabilization fund included to allow brokers and fund houses to leverage on the central bank's balance sheet to essentially support the stock market. However, this time around, you are hearing straight from the horse's mouth. The Politburo, which is a group of 24 top officials who oversee the entire party and central government in China today. So if they say they are going to support the stock market, you probably wouldn't want to bet against that. So what's so different this time around, you might ask? I would say, I think not much. So they're just repeating what the street is already expecting. In fact, if we look at the price action of the major indexes tracking the mainland Chinese market, everything seems to be already priced in. So the CSI 300 and the SSE Composite Index tracking the Shanghai Stock Exchange, and they are basically trading near the same levels after the September pseudo-stimulus pump. So you can keep saying that you're coming, but unless investors are convinced with your actions and not just your words, it's not going to amount to much results. If you're interested in Chinese-related stocks, you can try investing and trading with Moomoo. So they offer zero commissions on US stocks for Singapore users, and they also support trading of both Hong Kong stocks and the A-shares counterparts. And I also have good news for you. Moomoo is now offering a limited time sign-up promotion. Don't miss out the opportunity to enjoy a starter kit worth up to 2,266 Singapore dollars. More about that later on. So have you ever wondered what would your investment look like if you actually committed to a recurring investment since 3 years ago? For example, putting in a rough figure of $50 per week in an ETF tracking the S&P 500 from December of 2021 until today, 3 years later, and your portfolio size grows to over $10,000 with a rate of return of roughly 33%. And if you want to test it out yourself, you can just go into Moomoo's app, Accounts, RSP, and RSP Calculator. And I've started my own $50 per week RSP on Moomoo, so as the US market continues to trend higher, I continue to stay invested and keep buying. And this is the beauty of dollar cost averaging. Now, new users can earn up to $2,266 worth of welcome rewards. And this includes an up to 6.8% per annum return for up to 30 days on your first $50,000 invested with Moomoo's Cash Plus. So at the lowest tier, you can deposit a minimum of 3,000 Singapore dollars and complete 3 buy trades. And you'll get zero point 0.1 Tesla shares worth 47 Singapore dollars plus an additional $20 cash coupon exclusive reward when you sign up using my link below. Also, we have something special this Christmas. You'll get an entry ticket to the Christmas giveaway lucky draw, which will commence from 25th of December to 5th of January, where you will have a chance to win a maximum of $1,500 worth of trading cash coupon. And for those of you with more capital, you can look towards the upgraded rewards of up to 1 Tesla share that is worth 467 Singapore dollars. So this campaign will end in January, so you wouldn't want to miss this out. Link will be in the description. And thank you Moomoo for sponsoring this video. So in earlier videos covering these, I've made the assessment that given the September announcement from the PBOC, they've essentially revealed their pain threshold and set some sort of a price floor on the overall or general stock market valuation. In other words, if you're buying mainland A shares today, it seems like you're buying a call option that wouldn't expire because the downside is capped since your interests are aligned with the policymakers. However, therein lies two issues. First, you don't know when the policymakers will change their mind, and second, you might not lose money, but given the lackluster performance of the Chinese equity market, you probably wouldn't profit much from it either if there is no demand for Chinese equities. And interestingly, there was a recent video that revealed a comment from Xiao Gang, who's a former head of the CSRC, which is the China Securities Regulatory Commission. So he said that while top leaders did not officially set market level benchmarks, they become nervous when certain thresholds were being passed. So they became uncomfortable if the stock market benchmark, which is the Shanghai Composite Index, fell below 3,000 points. So the 3,000 point goal is just a psychological goal. It has no scientific proof and does not come with any formal government orders. But there is definitely a consensus amongst top leaders today. So simply put, when the index falls below 3,000 points, the so-called national team will step in to support the markets. So as manipulated as it sounds, welcome to the Chinese stock market. So I don't necessarily see this as a set of nefarious action by the government trying to control or manipulate, but it seems more like the desperate attempt to maintain a certain perception about the Chinese stock market. So is this a good thing or bad thing? I think it depends on how the investor play around it. But that said, we are talking about the mainland local A-shares market. So they couldn't care less about how the Hong Kong market performs, which is why we see a greater level of volatility with the Hang Seng Index. So the Hong Kong market is kind of like a litmus test to show how foreign investors express their view and confidence onto the Chinese market. So could you make money from it? At least for now, it seems like I belong to a small group of players that continue to ride the ups and downs as an investor, as opposed to trading in and out of the Hong Kong market. Now, circling back to the Politburo meeting, they announced plans to adopt, and I quote, a moderately loose monetary policy in 2025, a phrase that we haven't heard since December of 2009. And let me remind you, the context back then was the fallout from the global financial crisis. So this signals the China's top leadership might finally be getting serious about tackling this economic slowdown. So in any other situations, this would likely spark some sort of optimism amongst investors. But as I pointed out earlier at the very start of this video, many are already frustrated. So Chinese policymakers' repeated promises have eroded credibility. Without tangible actions to back up their words, it's hard to inspire confidence. Anyway, talk is cheap. After years of tea leaf reading, speculation, and false starts, investors and traders have been burnt far too many times. So this extended drawdown over the past 4 years or so has also come at a steep cost to investors' confidence. And for now, all eyes are on March 2025, when detailed plans are expected to be reviewed at the National People's Congress. Until then, it seems like another waiting game. So what's the end game here for both investors and traders? Do you buy more? Do you stay invested? Or do you not waste time with China's related stocks anymore? So I think it's a timely reminder to share a letter from Asia Genesis Macro Fund, which is a hedge fund based in Singapore that folded earlier this year. And I quote from the CIO, "I've reached the stage whereby my confidence as a trader is lost. So the recent tough trading has proven that my past experience is no longer valid. So we made big mistakes in the recent sharp Nikkei and Hong Kong moves, which went in opposite directions. So I still do not understand the inconsistency of China policymakers not fighting deflation, leading to the continued loss of market confidence and prolonged bear market. And we made another big mistake in trying to pick the bottom in the Hang Seng. So I'm astounded by the incredible Nikkei Hang Seng spread that priced Chinese versus Japanese stocks at the same value as in 1991, despite current economic realities." Unquote. So I don't know what you take away from that, but here are my key takeaways. For one, you can crunch all the numbers in your sophisticated models, but the market can remain irrational far longer than you can stay solvent. 2. Strategies like long short might seem enticing for chasing returns, but they're double-edged in nature. So be prepared to face consequences if things don't go your way. 3. Unless you are pressed for time, don't put yourself on a time leash. The market is unpredictable, and being caught in a precarious position, especially a leveraged one, can really lead to dire consequences. In fact, this macro fund's thesis might have been correct in the long run, but because they couldn't weather the storm, they will never have the chance to reap the potential rewards. And that might be one of the hardest lessons of all. Being right doesn't matter if you can't stay in the game long enough to benefit from it. With that, I'll see you in the next video, but more importantly, and hopefully, I'll see you guys on the moon. Goodbye!